Oh, you're recording. Okay, nice. Oh, wait, I didn't share my screen yet. Hold on a second. Hold on a second. Hold on a second. Ah, the Zoom is really, really annoying. Zoom, zoom, zoom. Okay, now I got it. Okay, got it. So good. So look what happened actually. I mean, I would like to go with over with commodities because you know there are some really good markets. Like, look, this is just an RGL, right? Look, you see, this is just an RGL, and this top fractal is just an RGL, and what happens is it becomes a bracket, what Ray calls a bracket, and the bracket is just a swing high, swing low, right? And you see prices. This could be a potential level 2 liquidity run, right? This could be a stop run. It comes back inside the range and it's testing the range again from above. So just imagine taking this. I mean, I'm not an oil trader, I'm not really familiar with oil, but this was a clean trade. Why? Because you could say, okay, this was as an order in an order block, like somewhere in here and in RGL, you could potentially take the trade on a 1 minute. If you go to the 1 minute and you look what's really happening here is you're coming into the London session, and this is prior to London, half an hour prior London, and price is pinning into this area, rejecting, failed auction, and from there we can just look at successful auctions. And look, I will just drag something into my screens. I'm currently doing a little PDF file or a PowerPoint, whatever, and it's basically just what the locals are, right? The locals are the guys in the pit, basically, and they're just trading hand signals. Like they're the ones on the floor, and I just made a PDF, like, for example,
this was symbol to trade on floor, old symbols.
Yeah, right. They're using hand signals, like
I see. And it's
I mean, it's probably the same on your trading floor in India. I don't know, but what I want to say is, I'm just working on a little PDF file, and this is really the most important part at the moment, or better, let's say, from here, right? Interns phase 1 is find the commercial, right? Oh, there. Find the commercial and avoid trading with them. You have to trade away from them. Where are the extreme prices? Level 1 is a price swing high, swing low. Level 2 is when a level 1 is rejected. Price rejects the swing and comes back into the balance area. So commercials are only trading extremes. So you have to think about it like this. This is the value area, right? This is for the most businesses, the 50. This is 100 and this is 0. And commercials trade, they can wait. They're patient because they don't have to do any business if there isn't any value. So what they will do is, if they see value at the bottom edge, they will buy it and distribute into the fair value. The same goes for the sellers. If the sellers selling at the 100, they will distribute into the 50. And this is where the 50 area comes into place. Balance area is just a 50 pullback. If it's rejecting the 50 area, passive traders are taking advantage because they recognize something, perhaps low volume on the down move, value, or just the lack of sellers. They're going to step in and cross the spread to take the market higher, because usually they don't want to cross the spread. They try to trade outside the spread. So if you think about it, this is the normal market profile, right? There's low volume here, and high volume here.
yes.
They don't have the spread here is really, really low, basically. So if they take business here, nobody else is taking business here except commercials. So what they will do is, basically, if they see something at the 50 pullback here, they will try to take the market higher, of course. And this is the thing. Commercials have the biggest pockets, the cleanest, sharpest intelligence. They're trading the actual black stuff. So they trade the gold, they trade the silver, they trade the oil, they trade it physically, they trade the physical stuff. They have to. And Locals are happy to do business with everybody except commercials because of the size. They will withdraw the liquidity away from the commercial, which will lead to a withdrawal of liquidity, big candle away from the 50, a big candle away from the POC, the point of control. So this is what the locals do. They try to sell into a down move. They don't try to buy it, because this is what Ray says. If you, the thing retail traders want, they want to buy this down tick, right? This red circle.
Yes.
But what they usually do is they buy this price here because they don't know where the low is. So they buy here, they're in the losing position. They buy here, they actually buy here. And they try to buy here, but they actually buy here. And this is where we want to sell. When you think I should buy it, you should actually sell it until the momentum becomes clear. So we want to trade momentum, you know, and this is something maybe just to remind you, with the interest exercise, we want to hunt the weak-handed traders. Remember, your first loss is your best loss. If you're in a bad position, get away from the trade as quickly as possible without even thinking or hoping that it's going to improve. I mean, I bet you was 100 times already in this situation. You had a bad position, even myself, and just thought, okay, maybe it will rotate, and it never rotated, and it took you out. So yeah, avoid the most recent top and bottom edges, except if it's a measured move, because a measured move will always give you how can I say, the confidence that algo buyers are stepping into the market. So if you're at a measured move, you're likely, look at this down move, right? How easy was it to buy this down move actually, right? I mean, it wasn't too hard, because why? It came into the series of down candles. Yes, I know it didn't hit it perfectly, but it doesn't have to, you know, it doesn't have to. And measured moves, for example, if you take the swing high and the swing low, I can tell you already, it depends how you take it. Maybe you take it like this here. It's like this here. But this is your guaranteed premium, and you know, even if you're a scalper, right, this is your guaranteed premium, and you get a little sell-off. What you do is you just take your 50 a little bit higher, and look where your guaranteed premium is, somewhere in here, right? 76, 50s, somewhere around this area. And look, it didn't even hit it yet clean. So maybe we have to wait, but this would be our guaranteed premium, for example, at this present moment. And this is what I want you to remember. Look at this here, for example, now. This here just came back to that RGL, to the 50. This is what we talked about, right?
Yes, and
Go ahead.
you said that this is your must be selling trade.
Yes,
But
yes. I want to sell it, but I don't want to sell it yet, because why don't I want to sell it? Well, this is the bracket, right? This is the bracket.
Okay.
We have a level 2 liquidity here.
Yes.
But the problem is we have a high volume candle now. This is the high volume candle. So we can say this could be a potential level 2 liquidity, but I would like to see personally, I would like to see a sell a little bit higher, just a little bit higher, you know, because
you are waiting for measured move.
Yeah, I'm waiting for the measured move, because it gives me the confidence that, okay, you know what, if I sell here, I can easily move my stop to break even. You know, it's just really that simple. But look at this concept, right? This is the 50. Look at the volume coming into the 50 until this candle. There is like no volume, and this is what I mean. This is basically what we just talked about here.
What do you mean by no volume? Means no green volume?
It's not about the color of the volume, but it's just about nothing is happening in here, you know, nothing is really happening in here. And the trend is, of course, what? It's bullish. So why would we fade now? Why would I sell, like Ray says? Why would I sell in here now? Why would I sell this here? Why would I sell this here? You know, I would lose only money if I do this. Why would I even sell this one? I mean, you can sell the higher high, right? But even if you sell this one, you're in a losing position. And this is where it comes to the last part of this whole exercise. Put a little box where the potential L2 commercial is. VMA 200, if price is above it, you can never sell. And the 20. So it's the 2200 VMA, the line has to be rising. The 20 just has to be rising. And we look for auction process. Okay. Test of the 200 VMA is the difficult phase. Avoid the trade because of a possible extreme forming. So if I do this exercise right now, right, I just delete everything and I just put 2 indicators on. It seems kind of stupid because I'm showing you now EMAs and you think maybe EMAs are stupid, but they're actually not so stupid because look, if we just take the rules, right, and we say if the price is above the 200 VMA, we can never be a seller.
Okay.
And this is giving us rules, you know, and trading is all about rules. It's just all about rules. And then I put the
What about
20 on it.
20? Yes,
And
20.
now I put the 20 on it. And now look,
Also,
you can buy when the 20 is rising. And where do you want to buy? You want to buy red candles. Because why, right? We have to look at the auction process. I would just delete everything right now and just look at the auction process. This is a swing high, swing low, right?
okay.
And this is a swing high. Basically until here, because this here becomes a break. But this here doesn't break the bottom edge, right? And it's above. And we want to buy the BSG squeeze, so we must be above the 50. We can't buy below the 50, we have to buy above the 50. So it seems like a stupid trade to do, right? It sounds like a stupid trade to do, but look, once it's above the 50.
If I compare both the situation of my market when it was sell off, and this market when you think that this will not sell off. So the comparison is the second time price did not below the 50, goes below the 50. So this is kind of shift in equilibrium. And
Yes, exactly. It's a shift in market structure, basically. Because look, if the sellers can't rotate price below the 50, right?
yes,
Where will price go to? Price will go higher. And look, if you sold this high, you sold this high. Some people are selling this, right? But they don't understand the simple concept of measured moves. And look, I will just, for this purpose, I will just draw out this line because this line will get hit anytime soon. I can guarantee you this. I can guarantee you this because everybody who's looking at this swing high, this swing low, he will have his profit take here and we will be a seller up here. So even if both lines are rising, we will be a seller because there will be high volume here. There will be high volume here. I will do the screenshot. I will just let it, you know, I always do screenshots. I delete them at the end of the day, but there will be, the trade will be here. There is no doubt. 2 pips above, 2 pips below, whatever. So
but internal exercise saying that you should not trade like commercial. So if
no,
market,
we should in your market.
Yes. So when it was sell off from second liquidity L2, so that was the commercial trade.
Yeah, it is always a commercial trade. The L2 is the commercial, basically, you know. So, for example, let's
What
just
was the difference between this and that? Only that price rotated below 50 is the only difference, and or any other difference?
look, basically what you have to do is if prices, if the VMA, right, if the 200 is above price, so you see there is some selling coming in here, but
yes,
there is high volume. So once you see this here, right, this candle here, this red candle here with high volume, because look at this volume, right? This is compared to this one, it's pretty low, right? It's like double the size. This candle is like double the size of this one.
yes.
And this must have some significance. It's not an order block or something. You can use it obviously as an order block, right? You can use it, but it's not about that it's the last candle. It's about the volume coming in because commercials, they're buying down ticks and they're selling up ticks, right?
It
So,
must be below the VWAP.
yeah, exactly. Because, for example, if we would have taken this trade in your market now, right? We would say, okay, we spotted the commercial, but we have to wait for the cross. So where is the cross? The cross is coming in here. This is the cross, right?
Yes.
After this candle, prices above the VMA. And once this happens, we can start to look for a failed auction and successful auction. So where is the first balance area? This swing high and this swing low here. We take the 50. We take the 50 out. This becomes our 50. And once price is above 50, even better if it's above 25, as you can see, right? This is becoming your squeeze trade for a measured move. It doesn't matter if the price is going higher or not, but this is your measured move. This is where you take profits, right? Always. And this is the thing. You see prices above the moving average. You see a failed auction. It didn't take out the 50 even. It rejected the 50, right? It came back above the 50 and it came even back. So imagine, just imagine based on a simple auction, right? Just think of one lot. We're just gonna think of one lot, okay?
Yeah.
So now I will have to do a screenshot. I will have to do a screenshot and put it in Paint because it's easy. This is like Ray always does it, and I think it makes more sense because I can draw there, you know. So if we look at this here, just at this price, right? And we think of everybody. Hold on. I need a, oh, okay, that's gonna be a little bit complicated. I need a brush. So we say there's a one lot seller, right? So somebody's selling in here. Let's say nothing to do with commercials. We have a one, right? Price is going down. Oh no, let's start from this candle here. So we have one lot buyer, one lot buyer, one lot buyer, one lot seller. We do a -1, we do a 1, a -1, a 1, a -1, -1, -1, -1, -1, a 1, a 1, a 1, a -1, a 1, a 1, -1, -1, and a 1, okay? And we just added together 1, 2, 3, 4, 5, 6. Let's do it like this on the way up, right? On the way up, we have 1, 2, 3, 4, 5 buyers and 1, 2, 3 sellers, right? So it's +2. On the way down, we have 1, 2, 3 sellers. So at this point here, right? At this point here, +2 - 3 becomes -1, right? So the sellers are actually stronger in this position. You see?
Yes.
How fast it can change. And look now, 1, 2, 3, 4, 5 buyers until the swing high, until this level 1, level 2 liquidity. So we have 1, 2, 3, 4, 5. We have now again to the top edge. We have -1, +5. We have +4. Who's underwater? The sellers are underwater, right? And then we see 1, 2, 3 sellers, +4, -3. We have still +1. And then this one comes in, +2. +2. Who's in control of the market? The buyers.
Yes.
And at some point, the sellers, they will have to give up. And look what happens. I will delete the screenshot. Look what happens. The sellers give up. Of course, you can do this exercise on and on and on, but you see, just based on one lot, simple one lot exercise, how the price is constantly changing from here to here, from here to the 25, and from the 25 to the measured move, because from here, right, from the swing high here, right, it's all big green candles, right? There are no sellers because the algos, they know, okay, it's time to withdraw liquidity. And that's when you see small red candles and big, large candles, green candles, I mean. Okay. And then they just try to shut down the business, you know, they just try to get away from this price as fast as possible. And of course, we can continue to do this interns exercise now, but this was just how can I say? I just wanted to show you the principle of the whole auction process. You know, this is the whole thing behind it. And we still, even though we have now this little balance area right in here, right? We can say, okay, this is a balance area. We can try, because it's the market close. The market is closing in the next couple of minutes, right? We can just make an assumption because, well, you know, this is the measured move here. The market is at a high from today. You see, this is obviously becoming a level 2 soon, because it's rejecting the high, rejecting. It's constantly rejecting, but we don't want to sell it here. We want to sell it somewhere in here. This is the safe trade. I know it's a lot of patience, you have to wait a lot, but if you wait a lot, you get less losing trades. And what we can do now is, because it's the last 20 minutes whatsoever, we can just think about an idea. We can say, you know what, there are some key levels like 17,850. This is like a key level, they could easily push the price up here really quick and then just drop down. And then you could also say, right, this was high volume on a downtick, right? Look, this was obviously a buy trade. You could even argue, and this is, you can do this on every single time frame you want, because if you take this swing high and this swing low, look where the 50 is, right? You can take it exactly like it is. For example, and now you could even say, you know what, maybe price will go all the way up to here, not today, but maybe tomorrow, because look, this is the swing low, this is the swing high, because this is a rejection. But look, price is above the 50, price is above the 50. The sellers are weak, right? The buyers are strong, obviously. And this is the trend. This is the trending market. You can't do nothing in a trending market except for buys, because the BMA, it was just buy side since the 28th of, yes, I know this was a balanced area, but you have to really identify the commercials. And the thing with this interns exercise is, if you avoid the commercials, right? If you avoid the commercials trade, you know where the commercial trade is. And when you know where the commercial trade is, guess what? You can start to trade the commercial trade because you know where he is, right? So if you see this level 2 rejection here and it's coming back above the 50, for example, if you take the swing high, the swing low, and you say, right, where is the 50? You want to be a buyer, of course, yes, the market's opening gap up, but this is a high volume bar, right? This is the RGL. This is the RGL right here. And look what happens. It's trading above the RGL. And guess what? If it trades above the RGL, it will likely continue. It will continue to trade above the RGL, because it makes perfect sense just on the moving averages, right? If the moving averages is trending up, this one is below the price, you can never be a seller, right? You can never be a seller. And what you will do is, you will just mark out your 30 minutes, 1 hour's RGL, your opening prices, basically. You will just mark out every opening price on every single day, and you will trade buy side above it or sell side below, right? And look, there was no possible sell trade in here. Even though you want to sell so badly, right? Even though you want to sell so badly, you cannot sell. It's not possible, just because of these two moving averages. Look here, for example, you can never be a buyer in here, right? You can never be a buyer. Why? Because look, there's an RGL. There's an RGL. And the moving averages are against you. So why the fuck do you buy it? I'm sorry for my words, but why would you buy it here, right? You can never buy it. You can never be a buyer in this type of market trend, because the market is in fact trending. Even here, when this closes with a gap down, what do you think? How many people bought this here? Probably a lot of people, and they all got stopped out. But once you see this here, this is what I mean. Once it tests the extremes, right? This is the extreme point. This EMA here is the extreme. I will put it even thicker. This is where the balance area comes into play. And then you also just take the next, this RGL, which I previously shown you. And then you can think about, okay, you know what? There's maybe a trend change, there's maybe a trend change. And of course, it is a trend change from this point here. But even if you waited, even if you would have bought here or here or here, you would have made big bang, So
Yes.
I know this is
Actually,
all.
yes, problem is putting the order either early or late, because sometimes RGL reject, then again test, then reject, then again test,
Yes, it's
kind of
you,
thing.
this is what I'm saying is, you have to have your RGLs in you always have to recognize the levels. So basically what I mean by that, what I mean by that is, let's look from a 1 hour perspective, right? And I know the 1 hour doesn't look too nice, but for example, if I just do measured moves, okay, I'm just doing measured moves now from where is the balance area, right? This is a balance area, this is a balance area. So I take this swing high, this swing low. Look, this is your measured move. You
So-
can, this is like a guaranteed price to buy, okay? And you see, obviously it is a guaranteed price to buy at some point. So
What about
even if,
buy side?
yeah,
This
but it can be profit taking, you know, this is the thing, it can be profit taking. So you have to be careful with the guaranteed discount and premiums.
Present time, can you mark the measured move? How I will mark in this situation?
What do you mean?
How I can mark the measured move in this situation, present time?
This here.
Like where you think that price is going for?
Where I think price is going for? Well, you can basically what you do is always look on the daily. Okay, the daily is really, if you think about it, you have your round figures and you already know, okay, there is 1,800 here, and if you, oh wait, 18,000, I mean 80,000, this is here, and on the daily it makes sense to go here because there's a lot of liquidity sitting above here, right? And the market is, like you see, in a trending market. So as long as there's no shift in this EMA, because look what happens just now, right? Even though it's the close now, price will do nothing except profit take. There will be nothing except profit take.
Where you think that the measured move is here?
Middle
-2.
move here from this,
Yes.
the middle move. I mean, what you can do is take daily swing highs and daily swing lows. So for example, this is a 1 minute chart, and you can take now, first of all, this swing high here and this swing low here, and this gives you an approximately target of here. But it always depends on where you mark your move out. You know, this is like the thing. If I take, for example, this swing low and swing high, then it gives me a range of approximately 1832, you know, from this whole range. And I don't know if it's gonna hit it, but if it is going to hit this level here, you can try to start looking for this 1, 2, 3 accumulation. I know it's not pretty, but 1, 2, 3, and then you say, okay, this is my trade here, you know, this is, you don't try to fade the market the first time, the second time, but if you see the third volume and it's decreasing, because everybody will try to sell now, and they will say, oh, this is good if you try to sell now, because they would just buy from them, you know, they will buy from them. Why? Because the market trend is higher, and of course, yeah, the market maker's book is net short at the moment, right? Because if you think about it, the whole market was balanced at this point, it was balanced, but at this point it's just net short, right? From 1, 2, 3, 4, 5, 6 candles. So what you will see is probably tomorrow you will see a buy trade in here, right? It would make sense, because if you think the market is bullish and it's going to the upside, then you don't want to buy a high price, but you want to see if this becomes a successful auction, a failed auction. You know, if it comes to the downside, you take your swing high, swing low. This becomes somewhere in your, this becomes somewhat of a 50, somewhat, not perfectly, but somewhat of a 50, and you just try a buy. And with the same concept, you know, you see, like, for example, the market opened here, the market opened here. This
Price is too much far from 200 WMA, so it will come back.
True. The blue EMA is not really important, you know. The blue EMA, it's more about this one here. It's more about this one, but the 200, right? The 20 is just, the rules are the 20 just have to go up. And if you think of on the 5 minute, because it's always depending on the time frame you're looking at, right? If you look on a macro time frame, which is the 15-minute, because this gives you a lot of data, right? This gives you a lot of data. This gives you like a whole month of data from 5th January to almost 5th of November. So 2 months of data on a 15-minute time frame, which is a lot. So you can say, well, okay, where
Price
are
is
my
not-
RGLs? Where are my RGLs in this? Look, this year, for example, right? If you would just do a little bit of RGL work, right? If you just say, okay, this is a nice RGL, this volume looks good. This is the 18, where is some good volume? This is some good volume. Look where the volume is coming in, right? It must be a key level, right? These things here, they must be key levels because they're all in the same area. And look what happens, basically. Look, I don't know what's going to happen to this RGL, but I can tell you, obviously, this gives a nice short, okay? We couldn't short it because this was a commercial extreme. We didn't have the EMA, but once this goes below it, now we can try to sell it. So you see, we don't try to sell this extreme, but if you take it like this here, for example, right? Once it's below the 50 here, this is your lower hold. And at some point, the 25, of course, I mean, you can even just do it like this, the 650, for example. This is your guaranteed premium. It never hits the guaranteed premium. It barely hits this one here. Doesn't matter, to be honest. I mean, but you see how they accumulate, right? This is again like 1, 2, and then 3, and this is like really aggressive. Like it opens already with a green candle to the upside, and once you see we're trading away from the green candle here, you can already say, okay, you know what, the EMAs are against me, but this is the RGL and this is an RGL. We trade below the RGL and we can say, you know what, this looks like a commercial trade, and it is the commercial trade basically, because commercials, they don't look to trade like for one day. They look to trade for 1 week, 2 weeks, maybe even 1 month, you know. And look what happens. This is 1 day, 2, 3, 4, 5, 6, 7 days, like 1 whole week of selling, right? From an RGL, look, I didn't make it up. The RGL was just here, right? I just marked out this stupid candle. If you just agree with me that this level has potential, right? And if you say, right, okay, this is like pretty huge candle, to be honest. But if you just take like 1 swing low and 1 swing high, like for example, if I take, what is this level? 1700, 17,000, right? And this is like 18,000. Where is the middle? The middle is 1750s, right? This is like fair value. This must be the 50 pullback. So what we look at is basically just swing high, swing low. You see, this is approximately the 50 pullback. It's always a zone. It's not a level, but you can already see if I really, if I take it accurately, right? If I take this swing high and I take this swing low here really accurately, you see this becomes the 50, right?
Yes.
Of course, yeah, they don't go for the full measured move because the full measured move is approximately 2,000 points lower, and this is pretty much a big range, but you can see they go for at least one measure, which is this one here. So on the lower time frame, it's a different measure. But what I mean is, look at this RGL here, right? This was a previous RGL and a previous 50. Look where we just look. This is from today, right? Look where we rejected. Look where this RGL came from. Do you see it?
Yes.
Like it's not some voodoo magic. It's just what it is. It is a level. It is a commercial level. It is a level where commercials deal. It is either sell side below, right? When it's below,
What
it is.
about other volume? Other volumes are also high, and this RGL will form daily. So problem
Yes.
is too much RGLs.
For me personally, I would just mark out the opening price because the opening price seems to have the biggest significance in the market. So for example, if you really take this volume here and you say this has pretty good volume, you see the opens always have the biggest volume.
Yes.
So if you just trade these, right, you can take a buy trade in here, you can take a sell trade even in here, because why? We're below the RGL, we have an order block here, right? You can say, well, this is good enough for me, this is good enough for me. We go above here, you say, I don't know, not too keen about that, but these RGLs are formed daily, and look even at this RGL here. These are just two RGLs. Look, this RGL here just came in where I can't make it up, bro. Like, look for yourself. It's spiced above it.
Well, my problem is if you mark daily RGL, so
Yes.
too much RGLs. So how I can sure that this is my main RGL, this is not a good RGL?
Yeah, this is the thing, man. You have to experience it for yourself, because what I personally feel like, look, for example, there are some RGLs which are good and RGLs which are bad. You know, RGLs can be a lot of things. Like, for example, if I just take gold, okay, my gold chart is empty. RGLs are not only high volume candles, they sure can be, you know, if I just, you see this high volume, right? You see, we're trading below it. So, and for gold, look at this volume. Look where it comes in, 2 o'clock, right? My time. And 2 o'clock my time, this is the Tokyo Open, and obviously China is dealing with a lot of gold. So you see this level here automatically, right? Has significance. When you're a scalper, right? When you're a scalper, let's say we're scalping the market. We see this and we see follow through, but on low volume, right? To the high price, low volume, decreasing volume. We don't want to buy this. We wait for pullback. You see a failed auction, right? This is not a successful auction. It didn't make a higher high. ICT, what happens? It makes a successful auction to the downside. So we want to start selling it. Where do we want to sell it? You can say, you know what? I'm selling this order block here, right? You can just, I know it sounds stupid, but you take this as your order block, okay? And you sell this candle here from 18.5s all the way down to 18.4s. That's 10 pips. And look what happens. Price is continuing to go down, continuing to go down. And you're in a good position, right? Because price is constantly making lower lows, and here now you see in level 2, right? This is the level 2 now, because it's not making real lower lows. It's like level 2, right? This is level 2. This here, the small here, the small one, and if you want to be so fair, you can even, I take this box here off now, because, and this here, right? This must be level 2 at some point. So what happens? Prices going up and it starts to take out the high prices. So now we just flip the script, right? Look what happens. We come back to that RGL, and the RGL is the decision point, right? For the time being, because it's for gold, this is like the main price. This is the main price. It's really important. Look what happens. It trades away from it, it trades above it, right? Look what happens. It goes away, right? It goes away, and it goes away beautifully. Look, it comes back, okay? It trades below it, and once it breaks below it, it stays below it, you know? It stays below it the whole time. Look what happens. It comes back, it goes above it, again, it goes below it.
Yeah, if you see in that RGL level, there is a multiple times testing that RGL.
Yes, it's testing it. It's on the 1 minute. Imagine it's on a 1 minute.
If I try to my entry, like where to put a stop, and
this is the thing, you have to be kind of, how can I say, you know, look, we're still trading that level, right? And from what I see, I would personally sell it, because why would I sell it? Because the Euro USD is obviously kind of selling, and my idea is to sell the GBP USD as well, right? So if you remember the screenshot, I'm still waiting